Welcome to episode 38 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with a sponsor that we've invested in, Bill Boffa and Darren Fultz of Willistown Capital. We actually talk a lot about the very deal that Minds Capital is in. Nicholas, what did you think of our conversation with Bill and Darren?
Well, let me first set the table here for what this investment was for us. Bill and Darren came to us in the fall of 2024. They had a company called Quiltcraft under LOI. It seemed like a reasonable valuation, a very strong market position, and a seller who was going to roll a pretty big stake and stay involved as a CEO seemed to be very strong. And so there was much here to like on a standalone basis. But what made this one of the most exciting prospects within our Fund 1 portfolio was that in some of the later slides in the deck, they talked about how we have the bigger competitor under or very close to being under LOI. This will be a transformative add-on acquisition right out of the gate. We're not going to be able to do them simultaneously, but hopefully within 60 days of closing Quiltcraft, we should also be able to close Fabtex. And that's actually what ended up happening. And so in this interview, we ask about how were you picked to be the sponsor to take down this really incredible opportunity where 1 + 1 equals, 3, right? With the two very accretive acquisitions together. They talk about the integration efforts of having two companies. They talk about how many stakeholders are involved when you have lenders and equity and two deals to take down, where any given lender or equity investor might pull out if one of the deals fall apart, right? They even say that many lenders didn't want to participate because of this risk. So here is an independent sponsor using the flexibility of the independent sponsor model and went all in. And they attribute that back to the relationship they formed with David, the seller, and that they just really felt a level of comfort and trust with him that enabled them to go all in.
Great. Thank you for that, Nicholas. One thing that I'll call out is we get to hear Darren talk about his own history with the sense of independent sponsorship. He learns about the model, I think he says 2013 at the time, it's fundless sponsor, and he's a little dismissive of the model as so many were at the time. And then he talks about in 2023, 10 years later, going to McGuire Woods and seeing a room full of capital providers that are eager to invest in this asset class. We know and we hear time and again about how much this the world independent sponsors, the model, the participants has grown and grown and grown. But it was fun to hear a first-person account of somebody who is watching from the sidelines and is now actually a successful sponsor himself in Darren. To the point about those capital providers, one other point that I liked in this interview was they talk about one of the powerful elements of the sponsor model being that you can pair a deal with the right capital provider. Which of course is something that we know. So you don't raise capital first and then find deals whether or not that capital and those deals go well together. You can pair on a deal by deal basis. But they also say that if you go out to capital providers and can't raise for the deal or struggling to raise for the deal, that probably tells you that the deal is a weak one. And I only bring that up because it's a variation on a similar point we heard recently where maybe subtle strength of the independent sponsor model is that because of this, it's deal by deal, and there's this fundraising exercise every time where you're going out and talking to smart people at capital providers. There's the benefit of getting all these eyes and brains on your deal, as opposed to just in traditional private equity, it's the investment committee. So there's this kind of market testing of the strength of a deal that is intrinsic to the independent sponsor model that you would hope leads to better deals being done. Max, what about you?
Well, I enjoyed this because we actually got to visit Quiltcraft in Dallas on our investor day, and we know Bill and Darren quite well from having invested in this deal. So it was fun to hear, more about a topic that we're quite familiar with already. But I would just say that the site visit to the target was pretty awesome. I think we all left that day enamored basically with this business. Being able to see and touch everything and physically be there is something that doesn't happen very often. And I like, Will, you said that typically we see these deals from behind the spreadsheet. And I thought that was a good way to put it. And I'm usually behind the spreadsheet looking at most of these deals, either at LCS, looking at a Q of E, or at Minds Capital, looking at diligence on the deal, looking at the SIM, the LBO model, the Q of E. And we are very much behind the spreadsheet most of the time. And I think it's important to point out that just by having physically been there, I got a little bit more in love with this deal than I think I would have been had I just been behind the spreadsheet. And that's important for sponsors to bear in mind, or anybody that's buying a business, really. When you go there and you get to know the people and you see the facility and you see the customers and you see the trucks and you see what's happening, it's exciting, it's interesting, it's energizing. You can get a little biased pretty quickly in that scenario. And sometimes it's good to go back to the folks who are behind the spreadsheet, the accountants, the attorneys on the deal, and to take a step back, because it's very easy to get excited and want to close the deal and picture yourself being there physically and having meetings there and things. But if there's a problem with the numbers, or if there's a problem with some legal issue, that may be a reason not to do the deal. And I think oftentimes folks get so close to these deals, it's tough to pull back when there is a strong yellow or even a red flag. So it's great perspective to go on site. I mean, there's just no substitute. It is energizing, but at the same time, I think, sponsors or anybody who's buying a business have to be mindful that you're going to get pulled into the business. The more times you go there, the more you meet with the seller, you're going to get pulled in, but you've got to try to stay independent. You've got to lean on your advisors, and you've got to be objective when you're looking at these deals. Don't overpay. Don't overlook things that might be a yellow or a red flag, and especially in terms of the financials. I see it all the time. I see sponsors and even searchers and other buyers, falling in love with deals despite numbers being a little soft and valuations being a little bit high.
It's such a good point. It was really exciting to see it in person. But as sponsors and buyers and investors, we actually need to be wary of our own emotional reactions and our own enthusiasm, and not get too far away from the spreadsheet. Love that point. Great. Thank you, Max. Before we turn to the interview, our reminder that Minds Capital is investing in independent sponsor deals. So if you are a sponsor with a deal under LOI, please send it to us. mindscapital.co. And if you are interested in investing in Minds Capital as an LP, we are actually raising for Flagship 2 right now. There is an investor registration form at that same URL, mindscapital.co. You can fill that out and we will be in touch. Okay, here is episode 38 of the Minds Capital podcast with Bill Boffa and Darren Fultz of Willistown Capital. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Bill Boffa founded Willistown Capital and brought on his business school friend, Darren Fultz, in 2023, when it was time to go from opportunistic deal-making to building a true investment business. Willistown has done 5 acquisitions to date. Minds Capital is thrilled to be invested in one of their platforms, the Threadwell platform. Always fun to have sponsors that we've invested in on the podcast, especially when it is going so well. Bill, Darren, welcome to the Minds Capital podcast.
Pleasure to be here. Thanks.
Yeah, exciting to be here.
So Threadwell is a market leader in its category, window coverings for the hospitality industry. And the two of you and the CEO of Threadwell generously hosted Minds Capital and our limited partners for a site visit at Threadwell there in Dallas during our annual investor day just a couple weeks ago. We had a great time. The partners at Minds Capital, our LPs, reported back to us that it was a highlight of the Investor Day.
It was a pleasure having you for sure. It was good to meet some people who we've only sort of talked to over email or phone previously. We are somewhat equally thankful of David, the CEO of Threadwell, sort of hosting us and showing off what they do so well there. So it was a great experience.
It was such an exercise in getting out from behind the spreadsheet. So, looking at these investments and thinking about them from an intellectual perspective, but then actually walking a factory floor, it makes a company seem that much more impressive in person than it does on paper. So it was really a great exercise for us. We really loved doing that. So thank you guys for hosting us. Again, that acquisition, it was actually an award-winning one. What are the ingredients of an award-winning deal in a local market?
We were fortunate enough to win the ACG Private Equity Deal of the Year award this past February. So we somewhat got under the line because we'd only closed the Threadwell transaction in December, so we just got in there before year end. I would say there's a committee that bases their selection on a number of things. I'm not entirely sure exactly what it is. At least from our point of view, what went well and why I think we were considered and ultimately won was, choosing the right partners in a deal. There's a lot of different service providers that you have to interact with on both sides of the table. Threadwell, they had engaged an advisor that happened to be here in Houston where I live. We used a quality of earnings group out of Houston. We had an attorney in Dallas. They had an attorney in Dallas. So there was, a lot of different groups we used, but all high quality groups kind of working together to get the transaction closed. When we think of reducing deal or transaction risk, it's very thoughtfully selecting those types of partners who you get along with, who are high quality, and that everybody's sort of working towards the same goal.
Beyond having a good set of vendors, both on the seller and buy side in this case, what do you think has to be in place to be considered for an award like this?
I think part of what made this deal special, and by the time the committee was reviewing the original acquisition of Coldcraft, we were already in progress with an add-on acquisition of a bigger company in their industry. So setting up the platform correctly with the partnership we had with David, the CEO, and then being able to, in parallel to doing that initial partnership acquisition, advance and ultimately close an add-on of a bigger company in February, 2 months later, I think was probably also part of the selection committee's consideration here.
You mean just because it was instantly so accretive and you already had formed the investment at the onset because you were combining two sizable companies to form a market leader effectively?
Correct. I think that doing the work on an add-on acquisition while you're doing the original platform acquisition creates quite a bit of complexity. And I'm guessing that was part of what the recognition was for.
I think it is more complexity, Nicholas. I don't even know if we submitted financials. So I think it's sort of complexity and the breadth of sort of services required almost, if that makes sense. A simple down the fairway deal that's, hey, you need an attorney and this and that, probably doesn't get the same consideration as, we probably had, 7 or 8 different service providers just on our side.
Yeah,
okay.
And you can imagine one day you're sitting in a meeting with the seller who you're partnering with opposite you at the table with his advisor. The next day you're at a meeting on the same side of the table with your future partner working on acquiring another business. So that sort of dynamic is a very interesting one you don't experience very often.
But Bill, what you said there about you didn't even show financials in order to get an award, that's intriguing because getting an award after you exit a deal, it kind of makes sense. You have a return profile associated to it. But on the entry side, so it wasn't related to, oh, we got a really good deal and it was structured so cleverly. It was truly just that the significance of this deal and the complexity of it put it on people's radar.
Agreed. And I think there's an element of, just personal relationships and how you work together, select and work together with service providers. I mean, it's very emblematic of what we try to do with potential business owners and acquisition opportunities, right? And how you carry yourself in, hopefully it's consistent between whomever you're dealing with, but that consideration and how you interact, because you guys know, dealing with attorneys, there's always things that become challenging and difficult. They're high stress situations, so that's something that you're always presenting yourself in some form or another, right? And doing it with service providers shouldn't be any different than when you're presenting to a business owner or an investor even.
Bill, you'd mentioned to us in the pre-call how the service providers, particularly attorneys, all being local and all themselves knowing of each other, maybe even knowing each other directly, that kind of stepping into a web of relationships there can be good for you, the sponsor. Can you share what you meant there?
Sure. It's oftentimes attorneys, have worked with each other on other deals. It's a hard thing to predict, and you can't really ask because oftentimes you don't find out until later. But they're, working with attorneys who are experienced, they've worked on transactions and with other attorneys, right? You just don't know exactly who. So having confidence that your attorney is well-versed in whatever industry or whatever, the kind of contextual elements of the transaction, can serve you very well, because oftentimes, a thoughtful seller has done the same sort of, gone through the same selection process. And again, it's not a silver bullet, but when it lines up, it just allows those tough conversations to happen a little bit easier.
And to be clear, the context, as you put it in this situation, was everybody being from the same market, everybody being in the same geography.
Yeah, correct. Yeah. And no, our attorney was out of Dallas, but so not a Houston base, but they have operations. Yeah. They do lots of deals in Texas, and the company we were acquiring were in Dallas. So in some ways, we sort of went to their market to find an attorney, which was not intentional, but it kind of worked out, fortunately.
Yeah, I'm actually working on a deal right now where we ended up changing attorneys midway through the deal. It's a little unconventional, but in replacing that attorney, we were specifically looking for counsel who have worked and collaborated with opposing sides counsel before, because we viewed that as a way to de-risk this transition and also maximize the chance of execution success.
It is. We've found it to be. Again, it's not sort of the be all end all, but having opposing counsels have confidence that the other side is sort of working to get a transaction done is really important, because attorneys are they are time-based service providers, right? So having everybody on the same page, sort of working efficiently towards a close is ideal.
You talk about how this deal was complex. There were two of them. Could you share what was your all-in range on legal expenses across doing two deals and the complexity here, if you were to give a ballpark?
I'd rather not. More expensive than we thought.
Right, but it would be right to say it's going to be a meaningful 6-digit expense.
7-digit expense. Meaningful 7-digit expense.
Really? Okay, got it. Yeah, so that's quite high, especially if you're a first-time sponsor, to chew off something like this. And so going back to what you said, deal of the year, being able to undertake this when you're a deal-by-deal practitioner, there is complexity and cost in it, and hence, meriting that award-winning feature of the deal, right?
Absolutely. Absolutely. And that's, as independent sponsors, this was an ACG conference. This wasn't an independent sponsor or kind of, ETA type conference. So the groups we beat out were, much better heeled and sort of large private equity funds here in town. So, it feels good. It's a good feather in the cap.
So going back to our visit on our investor day, one of the other things that really made an impression was the Threadwell CEO, David. Give us a little bit on the backstory of how it was that you developed that relationship with David and were ultimately selected to be the sponsors that he chose to partner with.
In the process, so there was a sell-side bank running a real process with timelines and competitive dynamics. When we met with the CEO, David, we went to lunch with him after our management meeting and really got into listening to what he was trying to accomplish in this transaction, and realized that he was really doing this to acquire another competitor and grow, and that was going to introduce some complexity. So in our LOI, we addressed what we heard. We also structured a transaction where he kept more equity in the initial transaction to keep a meaningful stake once we made the add-on acquisition, so he wouldn't be diluted too far. And I think that really appealed to him. And secondly, the add-on acquisition was complex. It would be a process going on while we're doing the initial deal. The add-on acquisition had facilities not only in the U.S. but also in Mexico. So there was an international component to it, and it was not going to be able to close simultaneously with our first transaction. So getting the financing right, setting up the balance sheet and capital structure to enable that transaction, and having the right partners involved, I think were the things that differentiated us.
You talked about how on one day you would sit on opposing sides of the table with the CEO now, David, and on other days you would sit on the same side working on this large add-on acquisition that you all had brought to the table with him. And so that's obviously a very interesting dynamic when it happens pre-closing of the first deal. So how is that? How do you build trust, or are you cagey? Are you a little bit careful about what you say in a setting like that? I mean, how can you be fully yourself and open and display all your cards as a buyer effectively, right, when you're also working with a seller at the same time?
It is a little difficult. It's not something we've really encountered much before, but I think we were really fortunate to do so, if for no other reason than we got to know David better, he got to know us better. One of the things more generally we focus on when we look at acquisition opportunities is the management team, is the seller, their character, how they handle their employees, how they treat their customers. And obviously that resonates in all interactions, right? So, being able to sort of negotiate terms that are still outstanding, but then also collectively sort of decide, like, this is how we want to approach sort of this issue and this potential add-on. I think it gave both sides sort of insight into how we think and interact and what it would like to be a partner, after the fact. So I thought we were fortunate, at least from my point of view.
But it's a risky proposition because here you're working with, when you're in a process, you want to build leverage over time.
Yeah.
And so here, and especially when you have 7 digits of legal expenses on the line, and in this case, you're actually decreasing your leverage because you're letting him in on the add-on, or he was part of bringing it to the table, of course, but you're showing your cards on this is what the consortium of 2 deals looks like to us. This is the feedback we're getting from our equity investors. This is how much buffer we have to work with. So at any given time, David, in this case, could turn around and make your life quite a bit harder, or renegotiate and retrade with you guys, or really put you in a perilous state. And so it's risky. You're definitely sticking your neck out here, right?
Yeah, I mean, I would say a few things to that. One is we were very much focused on learning the industry. We're generalists, so we don't come from the hospitality, furnishings, and window treatment space. And so I think a couple of things. One, we were able to build confidence in not only David as an operator and the systems he'd put in place, but also in the attractiveness of this bigger add-on acquisition. We would look at their systems and their processes, and we took some risks in the sense that I was in a meeting at the second target, and we were showing our systems to this acquisition add-on, and they were oohing and aahing and saying, "Oh, we wish we could do it this way. It's so much more efficient. That is a better way to do this." So there's trust and working, showing some cards on both sides.
Right.
We hadn't closed the transaction with David, but David showing his competitor how he runs operations in their software with real customer data, while the target is showing us how they do it, and they happen to, be manually re-entering data between a few systems. So we really got to know the industry. We got to know David. We got to see how Quiltcraft's processes were more efficient than the add-on that we were trying to do. And then also saw that there was buy-in from the key executives at the add-on acquisition to integrate and migrate onto Quiltcraft's now Threadwell's systems.
If I could add, David was going through the transaction process from his point of view, and I think had an increasing appreciation for how difficult it is and the complexities involved.
Right.
The idea of doing an add-on by yourself, I think it helped him realize that, like, oh man, I there's some things here that I don't know, or I really do need a partner. And which is exactly what we're trying to sell, right? It's what we've done before. So, there's always risks in showing cards and not showing cards. I would say we saw the benefits, versus the risks, and it was an easy trade or overall, beneficial and helped us. I think it probably did help us in our transaction with him.
And it shows high integrity on his side that he, at that initial lunch when you said, here's what I would like to accomplish. And then despite of how leverage increased or decreased for the various parties, he stuck to that. And you guys went all in, as shown by your legal expense and on pursuing 2 deals, complicated setup. You went all in, and that certainly probably saw integrity from you to him, which built that trust in a two-way manner.
Yeah.
And talking about partnering with David, we've gotten to know him, of course. I'm involved at the board level, and also we were there at the investor day. He truly is an exceptional founder and operator and CEO. We had a recent podcast guest who opined that only 1 out of 4 sellers can successfully transition to being a long-term CEO of the entity as it becomes. Because taking it from 0 to 20 on your own when you're the sole decision maker is one thing, but taking it from 20 to 100, per his example, with a whole new set of stakeholders and a new ownership table is, frankly, a very different job. So he said only 1 out of 4 can make that transition. But it seems abundantly clear to us who've seen David operate that he is, in fact, one of those 4. So how do you, as an independent sponsor, approach a situation where you're able to attract very, very strong partners like him? And let me also add into that you guys have a third team member at Willistown who's also exceptionally strong. So you guys are doing what we all talk about, attracting and strengthening your team by attracting really strong talent here exemplified by David and your colleague at Willistown. So how do you do that? And what are your screening mechanisms?
Yeah, Nicholas, I'd maybe introduce one nuance to that 1 in 4 number that you brought up. So I don't disagree that directionally that it's probably 1 in 4 founders who start a business and take it to 20 or 25 of revenue that can take it to the next level. However, David and in some other situations I've been involved in the past, David bought the business from his parents. So he didn't come in as a founder. He grew up working summers in the business, went out and had his own career for many years, and then came back to help out his parents, and ultimately bought it from his parents maybe a decade ago. So he had a different perspective already on the business, and I would say he's different than when you see a founder start the company and take it to 20 or 25. So I think that's a nuance that's important. I think to answer your real question here, which is how can you tell the difference in a CEO owner, and can they take it to the next level? A lot of it has to do with how they look at systems and processes, delegating authority, and putting things in place that can scale. I think that a lot of CEO owners become the limiting factor in their companies because they can't give up control. They don't hire strong team members that are better than them in the various functional areas, and delegate to them. And so those are a few of the points I would point out that we look for.
I would second that. They're as you look at the processes, how they do things in the business, how they generate revenue, the other senior team leadership members, what their jobs are in relation to the CEO, or the founder or whomever. I mean, if there's a bottleneck and it's the founder, owner, CEO, it's going to be a lot of work to undo that bottleneck because the organization's not designed. The organization's designed to filter things through the bottleneck, right? So, that's a very, very different situation than, what we have with Threadwell or in some case, what we look for. And now there are situations and there's structures where we may pursue those opportunities, but it requires a different approach, and it's you gotta be thinking about it differently when you go in.
Yeah, and maybe some of the social questions you can be asking are, how often do you go on vacation? Do you go away for several weeks and detach completely from the business? You can ask certain questions and go down certain angles to try to figure out how much of a bottleneck the CEO owner is.
When you do a transaction with a seller, you often bring a lot of value by just closing the deal and giving them a very solid first bite of the apple. And you augment the situation by bringing in strategy and white collar experience and M&A and all of these aspects. But in this case with David, he's, as we have agreed on, stronger than the average seller. And so you're now going to be working with someone, and does it affect the day-to-day post-closing that you're now operating with someone of that caliber where, the usual good enough is not good enough from your side? Are you more hesitant to jump onto your next platform because you want to give this the proper attention that David deserves from you guys? Or how does it affect how you view 2025 and beyond when it comes to partnering with someone of a very high caliber?
It definitely does affect the approach. David obviously had a vision, a much more thoughtful one than ours, because we were, he knew his business better. He knew the industry much better. So what we tried to do, and it was very deliberate, was to not insert ourselves too much, not try to influence, really anything related to the business. There were some obvious things that needed to be done after the transaction that he was, I want to say, happy to let us run with, but, administrative, legal things, kind of corporate administrative tasks. And then it was figuring out, just having conversations with him, to map out what the strategic plan was, considering we had an add-on, what the integration plan was, and, identify what resources existed internally, who could handle what, where we needed to bring outside people in, and where we could sort of, pick up the ball and run with it. So, fortunately it worked out well. And again, David, we've said a number of times, is sort of an extremely thoughtful and strong leader. But we definitely, with this transaction, it would be different than our other portfolio company, for example, or any others, because we didn't, oftentimes there's a sort of negative expectation that private equity comes in and tells you what to do. I mean, that's not our mantra. That's not what we want to do really ever. And we were especially thoughtful of that with David.
It's an interesting contrast, Bill. We had Nathan Chandrasekaran on a few weeks ago, and he talks about how he sort of joking, not joking, says to sellers, we're not founder friendly. And by that, he means that many sellers will want to roll and want to stay in the CEO seat. And he just wants to forewarn them that it will be a different experience when his firm is involved, that they'll be held to KPIs and a certain level of performance and less autonomy than they're probably used to. And that, in fact, there's a vision that they're coming to the acquisition with that the CEO, needs to be on board with. This feels like a little bit different, where in fact the vision came to you pretty fully baked, and you were there to support it. React to that.
It does sound different. I didn't listen to that conversation, but each business and each potential investment, I think, is situational. If there's a weakness or there's a strategy that's sort of external, there's going to be some disruption. One of the things that we value extremely highly when we look at opportunities is culture and people and how the processes happen. We want to invest and put our time and energy behind, good versions of those. Coming in with a lot of outside strategy and change generally is disruptive to culture, to people and the way a business currently works. Now, there are situations that require disruption, right? And it's a totally different approach. And we look at some of those. It's not what we're describing with Threadwell, of course.
Yeah, and I might add to that Bill had to persuade me of the independent sponsor model when I started talking to him about joining up and creating the next version of Willistown Capital here. And part of what really attracted me and came through in a very clear way in the Quillcraft and Fabtex transition to create Threadwell is that we have pure flexibility. We don't come in with any predetermined structures, constraints from investors, or anything we have to do. So we very much go in and say, let's go in with an open mind. Let's go in and listen to the people that know this industry, that are running the business. What are they looking to accomplish? What's their goals and objectives? And is there a way that we can fit in and create a solution together to enable them to do what they're doing? And that obviously it has to fit with us being successful in some way too. But that is the beauty of this model, is we can go into a situation and really listen to what the seller is looking to do and potentially tailor a solution that nobody else can tailor because they have all the constraints of their committed capital. And so I think that's ultimately what differentiate us here. And the risk of doing an add-on acquisition, incurring fees when you haven't even closed the platform acquisition, not a lot of people were willing to sign up for that, I'm guessing. Also, a lot of the capital we talked to said, well, we'll only do the deal if you've closed both, so close them simultaneously. That was also very tricky and something we looked at whether it was something we could accomplish, but ultimately it wasn't. So being able to thread those needles and come up with a structure and a process to basically give the seller what they're trying to accomplish and also do something attractive for us. That's where we differentiated.
And Will, if I could also add, when we ideally do not get involved in sort of big auctions, right? I mean, we're looking for sort of more curated, situations where an owner is looking for, even if they don't know exactly what type of buyer, somebody who shares the same values and has somewhat of a similar strategy or strategic outlook towards larger things. We often have sat across from a selling business owner and said, we might not be the right people to buy your business, right? it might be somebody else. And I would encourage you as, Mr. or Mrs. Business owner, try to, there's more than one, but there's a group of buyers who are the right buyers for you and your business. Obviously if we think if we're really interested in the business, we'll make our pitch as to why we're the right one. But we don't want to, generally, I'd say, don't want to get into situations. I mean, there's enough complexity with, transaction processes and risks and negotiating and then dollars and, employment agreements and things like that, right? We're not trying to add additional complexity where post-close, we're going to introduce a whole new strategy and kind of approach to how a business owner has successfully gotten it to a place where we've, where we want to take over.
Hey, Bill, question for you here. Today, Threadwell presents as a slam dunk investment. We're super happy to be a part of it, but was it always like that? Or was there a point in the diligence or pre-closing stages that, it carried its risks and costs? And is it so that the slam dunk was always one, or wasn't it really?
Slam dunk is, to me, that's the end of the game. So we're not quite there yet. And I don't know when the end of the game is. I would sort of present it more so. We talked earlier about, the complexity of the deal. This was a complex sort of situation. And at times there were risks that, were not so easy to identify or quantify or made kind of moving forward, or we had to move forward sort of thoughtfully and disciplined and kind of continually reassess. So, I think in the, throughout the process, from our side and even from David's side, we saw, the possibilities and the potential. So, we're not particularly surprised that it's been successful thus far and expect it to continue to be. But there was, we were reassessing risk throughout the process in advance, before the transaction happened.
Question for you, Darren. The first deal merited a standalone investment. We evaluated it as a standalone with Minds Capital, and then the add-on was kind of a nice bonus if it happens. But with the transformational add-on that this turned out to be, how does that affect how you think about, the exit potential or exit timeline? I know you're not really exploring that in any way yet because you're still in the first year, but based on your extensive experience from the M&A sphere, how do you think it might affect that thinking over time?
One thing we see is in the lower middle market, so let's take companies 5 million of EBITDA and below, the buyer universe is more constrained, and there's more risk inherently in those businesses, be it customer concentration, key man risk, the list goes on and on. If you can build a company that's north of the 10 million EBITDA threshold, and certainly into the mid to upper teens up to 20 million, the buyer universe opens up quite massively. There's much more. There's more private equity firms looking for platforms that have real systems, are professionalized, are scalable. There's also strategics. When you think of multi-billion-dollar companies, they need to add something big enough to move the needle. So a lot of those bigger strategic acquirers aren't looking at these smaller businesses either. So certainly the add-on acquisition accelerated the growth of this business and has enabled it to avail itself of some of those opportunities down the road more likely.
And another somewhat similar question is, I know you guys have experience from your extensive experience with many portfolio companies over time. And so the very nice question of excess cash may present itself sometimes in portfolio companies. What do you do with excess cash based on your experience, and what are the options, and how do you weigh each of them? What are the stakeholders for and against various options?
That's another good question. And if you do well, right, and have excess cash, it's a good problem to have. Generally, we're going to use some sort of debt at some level. I would say our approach is probably a little bit more modest than the average, or at least what the market would typically allow. That's just kind of, partly personal preference, but it's also partly, and this addresses the excess cash flow question a bit. It is our intention to grow the business, right? Over time. So, if you have excess cash flow, the first question is, can you put it back into the business in some form, right? Can you hire people? Can you, are there other acquisition opportunities, even if they're small ones, right? You don't need to do a big add-on necessarily. Oftentimes, smaller add-ons, allow you to acquire, a capability or a few different people or a different customer set. So I think the first sort of decision is what's the best use of the capital, and can you put it back into the business or in some way or another that helps you achieve your strategy and helps you grow faster than you would otherwise. Secondly, you're obviously looking to debt to pay down debt potentially. Oftentimes the SBIC world is very friendly for transactions like these. I wouldn't say the cost of debt is particularly onerous, but it's also not cheap either. So using debt, using excess cash flow to pay down the debt is those are probably 1, 2. Beyond that, you might start to think about distributions. Oftentimes that depends on kind of how you structured the business and taxes and things like that too. So.
Bill, switching subjects here a little bit. At the top, we mentioned how Willistown was kind of your evolution from opportunistic deal making to a formal investment firm. Talk a little bit about that trajectory, what you were doing before, why you decided to formalize, bring on Darren. It seems like an interesting history there.
Sure. So I have kind of a financial services and corporate finance background, and I was, I guess, sort of mid-30s and wasn't sure if I wanted to stay on that path for the rest of my life. I ended up working with one of my friend's fathers. He had left a CFO position at a publicly traded firm and ended up doing somewhat similar, investing in smaller businesses. And, I started and realized pretty quickly that I don't think I could ever go back to the big corporate environment. So when Willistown started, which is probably 2012 or 13, it was, my focus then was a somewhat uninformed focus, to be honest, naive and uninformed, but it was smaller. And all business is difficult, no matter what side, operating or investing. But you realize that many of the things that allow a business to grow, making sort of reducing risk in terms of investment or even operating the business, size really, really does make a difference. So I was fortunate enough to be involved in a transaction that was not a small one to start. We ended up have one of our investors sort of bought us out, and that was somewhat coincidentally right before COVID. So sort of through COVID and soon thereafter, I wanted to make sure Willistown, or that I was doing being part of larger transactions for no other reason than there's more opportunity. It's a different risk profile.
And what size of businesses were you doing?
Started probably sub 10 million enterprise value. Got into one that was kind of mid 20s and exited kind of, closer to, double digit, high end double digit million. So now I would say, we're probably focused on businesses, 15 million in enterprise value would probably be the low end, but 20 to 40 ideally. And again, it's, Nicholas mentioned it earlier, and Darren talked to it a bit. It's processes. It's the, the things that separate a business from, from 5 million to 10 million in revenue, that's a big step change. 10 to 20 or 25 is another big step change. And then there's the, 25 and beyond. We're trying to be a part of the 25 and beyond step change now.
So you decided that bigger was better. And that meant formalizing and partnering with Darren. Take us up to when Willistown became its kind of current incarnation.
Sure. Good question. I was thinking of how best to do it. I did, over time realize that, while I think I have some strong skills in certain areas, I'm not the best at a lot of things, right? I'm not even the best at some things, but I knew I needed a partner. And it was really by coincidence, Darren and I had been friends since business school, and it's pushing 20 plus years now. But he and I had talked somewhat regularly, for the last 20 years. And when he sort of he became available, we started having conversations like we'd had, dozens of times in the past. It's just that, he was now sort of looking and thinking of what else to do. So at that time, I was also a little bit more confident in the opportunity that I saw and what I wanted Willistown, not necessarily what I wanted it to be, but what I thought it could become. So,
and what was that? What was that vision? And as you presented it to Darren?
The easiest way to describe it would be sort of a private equity firm, a solid middle market private equity firm, at least as the competition set. Now, being an independent sponsor is a little bit different. There are pros and cons relative to a middle market private equity firm. But I honestly do think the flexibility that we have as an independent sponsor, which Darren briefly spoke about, I don't know if hopefully we continue to grow. Hopefully we do a couple more transactions. For us to, consider moving to a more traditional fund is, that's not a given. It's not something we're necessarily striving for now. But we do want to be able to kind of compete more effectively with those types of groups.
Mm-hmm. And so initially that kind of did seem like a natural or an aspired to destination, and now not so much because the deal by deal model is so flexible, the word we always hear.
I would agree. And I do think just generally the capital that is interested in investing in private equity, bankers, lenders, even business owners, independent sponsors, there's increasing credibility. Hopefully this transaction our transactions will sort of add to that credibility. But I do think, the market is making independent sponsors more credible, and, successful independent sponsors will continue to do that.
Darren, how did the pitch land on your ears? What were some of the alternatives you were considering, and what clinched it for you?
Well, so it wasn't really Bill pitching me. I think it was more a conversation over many months about what is the opportunity out there. Like I said earlier, I needed to understand the independent sponsor model better, because in my prior fund, we would have fundless sponsors come to us with deals, and I'd look at, their ask, and we a lot of what a fundless sponsor would do would be duplicative to the work we would do in my prior fund. But so I'd sort of dismiss fundless sponsors as a tough category to ever believe in. So the first 2 months, I'd say Bill and I just talking about what is this independent sponsor model? How does it work? Why can it be attractive? And I think going to McGuire Woods in October of 2023, after several months of talking to Bill and seeing how many capital providers were looking at this asset class and wanting to back these deals, was probably one of the biggest aha moments for me. If you can find a good deal and get it under LOI, there is plenty of capital to get it done. And so knowing that, I've done over 100 acquisitions in my career, once something's under LOI, that process to get it to close is very navigable. So going to the McGuire Woods conference in October of 23, I think was the real eye opener for me. There are 1,500 people there. There's 70 SBIC, mezzanine debt and equity providers looking to fund these types of deals. There's more and more equity capital providers that are institutionalized looking to back independent sponsor deals. So I became very confident that if you can find a good deal and get it under LOI, we can find the capital to close. And then you look at the flexibility of not being in a fund and not having the constraints of only these industries or only these deal sizes, deploy the capital by this time frame or you lose it. It just made a lot of sense that we could go out and build something together. And so that towards the end of 23 is when I said, let's go do this. Let's go have a run at it.
And Darren, what do you think you had missed when you were kind of dismissing the fundless sponsor from your other perch earlier on? What had you missed about the model?
Well, I think I'd sort of dismissed the model maybe in the 2013, 2014, 2015 time range. And I think the model has matured quite a bit since then. So one thing, one was just a knowledge thing. I didn't know the amount of capital available to this asset class or to this investment approach. And from what I've heard, it's changed quite a bit from the first McGuire Woods conference to today. And I don't know that all of the SBIC firms that are out there today were really chasing and backing independent sponsors if you go back a decade ago. I don't know that much has changed about the model. Maybe it's just that it's a mature, accepted model, and seller advisors also aren't running the other way when they see a fundless sponsor come knock at their door.
I also think, Will, to say that capital is a commodity, I don't think is, a surprise now. So if sort of you take that off the table, it's experience, it's interest, it's approach, it's people who've done transactions before, who've worked with, worked on transactions, talked with business owners and selling business owners, come up with the strategy and grown businesses. If you take capital off the table, there's no difference really between, now you have to have the experience, you have to have, be able to sort of, support the, what you're trying to do with real world experiences, et cetera. But the capital's, really not the limiting factor, right?
Yeah.
Yeah. And that's what's so great about this model. Capital is not the constraint. We might go raise a fund down the road in many, many years. If capital becomes the constraint, then having committed capital gives you an advantage. But I would say in this market, in this environment, the amount of capital available for good transactions, having the flexibility to go to the capital that likes your deal is extremely valuable. So if you raise capital and you have committed capital, you're constrained. If you have a great deal, and we're industry agnostic, we're size agnostic, we're geography agnostic. So if we can find a great deal and we can't fund it, we probably shouldn't do the deal because the market just told us there's no capital available for this deal.
And oftentimes they're, like sort of our pitch to business owners, there's a right group. There's better capital than other capital, right? And given a specific deal in a specific industry or what, certain dynamics, capital A versus capital B might be really, really different. And, that's an added benefit that we could potentially bring to an opportunity.
You had said that Willistown 1.0 bill, and you were successful as an independent sponsor, but it was more opportunistic and more situational. And the motivation to bring in Darren was to make a more institution-grade independent sponsor. Can you guys give some examples, like specifically what is that difference? What are the things you're doing now that didn't really happen tactically before?
Sure. I'd say the biggest thing, and not to sort of continue to use this excuse, complexity, size and complexity. And it's really just bandwidth. I mean, the transaction process, even managing a deal, managing a portfolio company after the fact, it requires a lot. I knew, after having done a few of these that, there's other expertise out there. And, even if I, sort of had the ability to manage, a situation, it would be taxing, right? It consumes all your time. And part of the challenge of, starting up as an independent sponsor, is it's the blessing and curse of winning a process, executing a deal, and then managing the deal, right? It's hard to do anything else. And I'd done that a few times where you chase something and then you get it, and then everything else falls off the table because now you have to manage it, right? So it's sort of this stop and start. So a lot of, I think, what Darren and I talked about in the beginning, and what we're continually thinking of, is how do we put all that we need to behind a new opportunity or our existing portfolio companies, while also sort of being out in the market and trying to find the next one. For this foreseeable future, we're never going to be a high volume, do three platform transactions in a year. But we do want to keep sort of stretching our legs, growing Willistown, but we also need to manage our two portfolio companies as effectively as we can. So bringing on Darren was logical. I mean, he's got a ton of experience. Our skill sets are very, very complementary. He's much better at some things than I am. I think I have some areas where I'm pretty good relative to him. So, Willistown itself is a business, right? Similar to another operating business. And that's how we're thinking about it. So making sure we have, enough people. Fortunately, we can use some outside resources. So being able to do that effectively and figure out how, where we want to take it and how we get there, and, how we reinvest in the firm.
Well, Bill, Darren, thank you guys for coming on and sharing about Willistown, but also about the deal that we were already pretty familiar with. But love to hear even more about it and share it with the audience. It's a really exciting one, Threadwell. So really appreciate you guys' appearance on the Minds Capital podcast. We'll link to your LinkedIns and Threadwell and Willistown in the show notes, and people can reach out that way. And once again, thank you very much.
Thank you,
Thank you, Will.
Have a great day.
Thank you, Nicholas.
Happy Halloween.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraises. See you in the next episode.